Before we dive in, hit subscribe so you don't miss new episodes. If you find value, iCleave helps us reach more people. Let's get started. Welcome to the Deep Dive. Today we're really focusing in on something bubbling up in private equity, how to handle these liquidity challenges using NAV lending.
Yeah, it's definitely a timely topic.
Absolutely. I mean, you see it everywhere. Exits are stretching out.
Yeah.
Getting traditional credit isn't as straightforward.
Exactly.
So for the big players, fund managers, LPs, family offices, HNWIs, this NAV lending seems like a way to get capital without, being forced into selling things off at the wrong time.
That's the core idea, really. It's becoming a vital tool in the toolkit, especially now. Our mission today is basically to unpack it. What is NAV lending, really? Why is it popping up so much now? And what are the actual strategic wins?
Okay, good plan. Let's jump right in then. NAV lending. What is it fundamentally? How's it different?
Well, at its heart, it's financing secured by the net asset value, the NAV, right, of a private equity fund or maybe a specific chunk of its investments.
Okay, the NAV.
Yeah, and the key difference, especially compared to, say, subscription lines, which people might know.
Right, those are pretty common.
Yeah, sublines are backed by the LP's uncalled capital. It's about future money coming in. NAV lending leverages the value that's already there, the value created in the portfolio companies the fund holds now.
Ah, I see. So not future promises, but existing demonstrated value, like borrowing against what you've already built up in the fund.
Exactly. You've nailed it. Think about a fund that's been running for a while. Its companies have grown.
Matured assets.
Precisely. NAV lending lets them tap into that value. It's an alternative to just waiting for an exit. And the borrowers, typically the PE funds themselves, maybe holding vehicles they use, or even big investors' family offices, for instance, who hold significant LP stakes or GP interests.
Gotcha. And is it just one type of loan, or does it come in different flavors?
Oh, definitely different flavors. It's very much tailored. You've got recourse versus non-recourse structures.
Okay, what's the difference there?
So, non-recourse, sometimes called secured NAV, basically limits the lender's claim mostly to the specific assets pledged. It offers some protection. Recourse means the lender might have claims beyond just those pledged assets.
Right, wider exposure for the borrower, potentially.
Potentially, yes. Then there's seniority. Senior debt gets paid back first. Mezzanine is more junior, higher risk, maybe higher return for the lender. And the facility itself can be a term loan, lump sum, fixed repayment, or a revolver. More like a credit line you can draw on and pay back as needed.
So a lot of flexibility in how it's set up.
That flexibility is absolutely a key strength, tailoring it to the need and the risk appetite.
Okay, that makes sense structurally. But let's get to the strategy. Why is this becoming such a hot topic right now? What's the real advantage?
The biggest one, hands down, is getting liquidity without having to liquidate. Especially, as you said, when exit markets are slow or maybe valuations feel a bit depressed.
Right, avoiding a forced sale when the timing's bad.
Exactly. Selling under pressure like that can really hammer your returns. NAV lending gives you breathing room, an alternative way to get cash without those suboptimal sales.
It gives you options when things are tight.
Precisely. Optionality. And it's not just damage control. It lets funds be strategic. Hold on to those star assets longer. Wait for the right time to sell. Maximize the value. That directly helps preserve and hopefully boost the IRR.
The internal rate of return, yeah, that's the magic number everyone watches.
It really is. So protecting that is crucial.
Beyond just holding assets longer, are there other ways it helps manage capital?
Oh, absolutely. It's quite flexible. Think about timing gaps. Maybe a fund needs cash for a great new deal now, but distributions from older investments aren't due for a few months.
A bridge facility, almost.
Kind of, yeah. An NAV facility can bridge that gap smoothly, or just managing general fund-level working capital, or maybe seizing a quick follow-on opportunity in a portfolio company without needing a full capital call or waiting for an exit.
So it greases the wheels internally.
It does. And what's really smart is how it's tailored based on the portfolio itself. How diverse is it? What sectors? How old are the investments? What cash flows are expected?
It's not just a generic loan then.
Not at all. It's quite bespoke. And importantly, think about the alternatives. Raising more equity at the fund level could dilute existing investors. Selling LP stakes on the secondary market might mean taking a discount. NAV lending lets you keep that ownership, keep that potential future upside.
Right, you retain the asset.
You retain the asset and its potential, minus the cost of the loan, of course. It's about optimizing the whole capital structure, not just plugging a hole.
Okay, the what and why are becoming much clearer. Can we make it more concrete, maybe walk through a couple of real-world scenarios where this plays out?
Sure, let's do that. Imagine a family office. They've got investments spread across several good PE funds, a nice diversified portfolio.
Okay.
Then, boom, a big capital call comes in for a fantastic new fund they really want to get into. It's unexpected or maybe just larger than planned.
Happens all the time.
Right. So instead of scrambling to sell some of their existing LP stakes, maybe at a loss, maybe incurring fees or selling public stocks they wanted to hold.
It could use NAV lending?
Exactly. They could take out a NAV loan secured against a part of their existing well-performing PE portfolio. Gets them the cash quickly, lets them make the new investment, and they don't have to mess up their long-term strategy.
Smart. Keeps everything intact while meeting the immediate need. What about for the PE funds themselves?
Good question. Okay, picture a PE fund. One of their portfolio companies has a great chance for a bolt-on acquisition buying a smaller competitor, maybe.
Strategic growth opportunity.
Yeah, but maybe the fund doesn't have much uncalled capital left, and they don't want to dilute their own stake in that growing company by bringing in other equity right now.
So how does NAV help?
They could secure a NAV loan, maybe collateralized by a diversified pool of their other portfolio companies, the ones not involved in this specific deal. That gives them the cash to fund the acquisition through their existing portfolio company.
So they inject capital without changing the fund's ownership structure in that specific company.
Exactly. Facilitates growth, increases the overall fund value, preserves their equity stake. It's using the existing portfolio value to fuel further growth.
Makes sense. And you mentioned secondaries funds earlier. How do they fit in?
Right, that's another interesting angle. Secondaries funds, their whole business is buying existing LP interests from others. That takes a lot of upfront cash.
Sure, they need capital to deploy.
So they might acquire a portfolio of LP interests and then use a NAV facility secured by those same interests they just bought to help manage their own working capital while they wait for distributions to start flowing from those acquired stakes.
So it helps them bridge the gap between buying the assets and getting cash back from them.
Precisely. Manages cash flow, lets them potentially do more deals. It shows the versatility, right? Different players, different needs. But NAV lending provides a tailored solution.
Definitely versatile. So let's circle back to the why now. We touched on longer exits and tighter credit, but what else is driving this surge? It feels like more than just those two things.
It really is a confluence of factors. You've got the extended exit timelines, that's huge. IPOs, M&A, it's all taking longer, more uncertain. So funds need liquidity for longer.
Read the structural need.
Absolutely. Then the tightening credit from traditional banks, as we said, private credit has stepped in, and NAV lending is a specialized part of that, filling a gap banks might be hesitant about.
Okay, so macro environment. What about within PE itself?
Well, the sheer size and maturity of private equity now is a big factor. It's a massive global asset class.
Trillions of dollars.
Exactly. And an industry that size needs and frankly developed more sophisticated financial tools. NAV lending is one of them. Also, lenders, particularly the specialized private credit funds, have gotten much better, much more comfortable underwriting PE assets. They understand the risks. They've seen the performance over cycles.
More experience, more data, maybe.
Yes, that too. Transparency has improved. Better reporting, more standardized NAV calculations. It all helps lenders get comfortable. And don't forget, the fund managers, the GPs. They're much more sophisticated now in how they think about fund finance.
It's not just about raising a fund and investing anymore.
Right. They see things like NAV facilities as strategic tools, part of optimizing the fund's capital structure, not just something you do in desperation. And finally, you just have more capital chasing these deals. The growth of private credit funds means there's more money available for NAV lending, which drives innovation, competition.
And probably makes it more accessible.
Exactly. All these things are feeding off each other. It explains why you hear market size estimates potentially topping, $100 billion soon. Seems plausible.
Wow, okay. That's a significant market. But it sounds complex. If a fund or an LP is considering this, what are the key things they need to really scrutinize?
Oh, it's definitely not a simple sign here transaction. You're absolutely right. Careful evaluation is critical on both sides. First off, valuation discipline.
How the NAV is actually calculated.
Precisely. Lenders will dig deep into that. Is it credible? Consistent? They might require third-party valuations, and they'll be thinking about how market swings could affect that NAV.
And how much they'll actually lend against that NAV, the LTV ratio.
Crucial point. The advance rates, the loan-to-value, tend to be pretty conservative. Think maybe 20% to 50% generally.
That's quite a range.
It is. And it depends heavily on the portfolio. How diversified is it? What's the quality of the assets? How liquid are they perceived to be? A very concentrated portfolio, or one with lots of early stage stuff, will get a lower advance rate.
Makes sense. And I assume there are strings attached. Covenants.
Always. Lenders need to protect themselves. So you'll see covenants like minimum NAV levels, limits on overall leverage, detailed reporting rules, maybe restrictions on distributions or selling certain assets.
And if you breach those,
that can trigger defaults or other consequences. So the borrower needs really robust internal systems to track everything and stay compliant.
what about choosing the lender? Does their specific expertise matter?
Hugely important. You really want a lender who gets private equity, someone who understands illiquid assets, complex fund structures, maybe deals crossing borders. It's not generic corporate lending.
Specialized knowledge is key.
Absolutely. And the legal side is intricate too. Securing the loan, pledging the actual LP interests or shares in holding companies or rights to distributions, it's different from pledging future capital calls like in a subline. Needs specialist lawyers.
And the cost? Is it expensive?
It can be. It's specialized finance. It reflects complexity and illiquidity risk. So interest rates and fees might be higher than, say, a traditional bank loan or even a subline. You have to weigh that cost against the strategic benefits, the liquidity, the preserved IRR.
So a cost-benefit analysis is essential.
Definitely. And robust risk management on both sides. Borrowers need to stress test how they'd handle different scenarios. Lenders need rigorous underwriting and ongoing monitoring.
Okay, so putting it in context, we've mentioned sublines and secondary sales. How does NAV lending sit alongside those in the fund finance toolbox?
Good way to frame it. It's part of a broader toolbox. Sublines, as we've said, are typically shorter term for bridging capital calls based on LP credit quality. NAV lending is about the value already in the ground, the assets acquired.
Different purposes, different collateral.
Exactly. But they can be complementary. A fund might use both at different stages of its life, use a subline early on for efficiency, then maybe a NAV facility later for portfolio liquidity or strategic moves.
And compared to selling on the secondary market.
The fundamental trade-off is ownership. Selling your LP stake gets you cash, but you give up any future upside from those assets and maybe you sell at a discount. NAV lending costs you interest and fees, but you keep the assets. You keep that future potential.
So retain versus relinquish future gains.
That's a key part of the decision, yes.
Looking forward then, what's the trajectory here? Is NAV lending just a feature of the current market, or is it really embedding itself into how PE operates?
I'm firmly in the camp that it's embedding itself. It's becoming a structural part of sophisticated fund management. As PE continues to grow and mature, the need for these kinds of liquidity solutions isn't going away.
If anything, it'll probably increase.
I think so. And we'll see continued innovation. New lenders are coming in. Existing ones are creating more flexible, more tailored products, maybe facilities focused on specific asset types or for particular kinds of borrowers.
So more specialization?
Yeah, I expect so. It's really moving towards being a standard tool for proactive liquidity management in the PE world.
So wrapping up, the main takeaway seems to be that NAV lending isn't just a loan, it's a strategic tool. It's for proactive management, optimizing how capital works within the fund, and ultimately performing better, especially when holding periods get longer.
That sums it up well. It gives managers and investors choices beyond just selling assets or calling capital. It allows decisions based on strategy and opportunity, not just forced by immediate cash needs. It really unlocks a level of financial flexibility that's increasingly valuable.
It's about managing the value you've already created, not just chasing the next deal.
Exactly. A shift towards more dynamic management of the existing portfolio's value.
Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.